So we were seeking funding, an accordion or a revolving credit facility in respect of a UK residential property trading fund. So a fund that essentially was using a pricing arbitrage that it was exploiting in the UK residential market. So the premise behind the client's business model was to trade assets. In essence, they were taking a very small turn on each single deal, but in aggregate, by doing the churning frequently, they were generating a healthy overall return for the fund investors. But that in itself created quite an operational challenge for any funder in terms of trying to take a lot of security from the collateral pool and to constantly then be releasing that security as it was traded out and taking fresh security coming in. So we overcame these operational challenges in two ways. First of all, we over-collateralized the loan ahead of time, and that meant that the sponsor had access to funding as and when they needed it. And secondly, we introduced an insurer who underwrote each discrete asset, did the due diligence on those assets, so that when it came to funding, they had essentially provided a level of cover to the funder, equating to the loan principal being advanced. So we were just seeking a 50% LTV facility secured against the underlying collateral of the fund, being the residential assets. Not especially aggressive. The purpose was simply to provide a degree of liquidity to the fund in respect of redemption of units for its underlying investors, as well as some modest level of gearing for the underlying asset investments themselves.